All right, let's get another voice on this because U.S. stocks, they're nudging higher here, coming off a winning week on Wall Street, a fresh record close for the Dow. Investors are now looking ahead to a slew of Fed speak and new inflation data this week. Chris Versace, Tematica Research Chief Investment Officer, joins us now. Chris, it is good to see you. So I want to pick up on the conversation I was just having with Maddie there. It does feel, Chris, like the Fed did deliver that outsized cut last weekend. And maybe investors are just trying to figure out, okay, now what? What comes next? What does the path of cuts look like from here? You see investors today, they're kind of slicing and dicing the comments and commentary from our Federal Reserve policymakers. But what do you think, Chris? What does happen next?
So I think you're right. We've got about a dozen Fed speakers this week, including the big dog, Fed Chair Powell, on Thursday. And everybody's trying to figure out, we've got 2 meetings left in the balance of the year. How, if they do 50, how's it going to be spread? I'm more in line thinking that if we get 50, it's going to be in 25 basis point increments. But to be honest, I think we're going to have to follow the data and see, whether or not 50 is actually on the table. If we take a look at some of the data we got today, the S&P Global Flash PMI, it says the employment market weakened for the second consecutive month. That probably means that the Fed's likely to do more than not, but we've got a slew of data coming.
I'm wondering if you think that the Fed was clear about their path to 50 heading into last week's meeting, and what you think about the upcoming rate decisions that they have, Chris. I know you said that they're going to be data dependent, but do you think that traders on Wall Street also need to be, monitoring news reports from some other media outlets out there in order to get insight into whether the Fed is thinking 25 or 50?
So before I answer that, let me say this. I think the biggest mistake that the market has made in misjudging what the Fed is likely to do is, the market getting out over its skis, anticipating too much. This time around, we saw this last minute shift from 25 to 50. The market was right. But remember what happened earlier this year when Powell had to walk the entire market back, and we saw it kind of collapse in April. So I think your point at the end, Madison, is right on, which is that we need to triangulate around the data, not just the employment data, but everything else about inflation, the speed of the economy. That's going to be hard economic data, but also other indicators as well, whether it's things like truck tonnage, or even weekly rail car loadings, which actually turned up surprisingly strong in August, and that's continued into September.
I'm curious, Chris, after the kind of run we've seen in the market, what you think valuation looks like at these levels. The strategist David Rosenberg, Chris, telling clients in a note this morning that a forward PE multiple of 21.5 is egregious, Rosie says, in view of the historical norm of 16 times. What do you make of that, Chris?
I have been saying that it is stretched. If we just look on this year alone, it's trading, coming into this week, 23.4 times forward, something like that. We right around where we peaked earlier this year. The big question to me going forward, though, Josh, is, if earnings expectations continue to slow for the second half of the year compared to the first half, it means the market's even more expensive. And then we have to start looking forward. And the question is, can the economy and the market deliver almost 15% earnings growth next year? Yeah, we know the Fed's going to be cutting, potentially another 50, potentially another 100 basis points next year. But, this is the discrepancy between no landing, soft landing, hard landing. And that's what we're trying to figure out.
So what could lead to a potential pullback in equities, Chris?
Well, there's a couple things, right? So, one, people just being concerned that the market is stretched, near-term overbought, and the valuation is extended. That could lead to a pullback. But we also have this upcoming longshoremen strike that could be, really crippling to supply chains, particularly on the East Coast and the Gulf Coast ports. Could also kind of, tick inflation back up. And if that happens, then we have to re-question what the Fed may do between now and the end of the year. There's election concerns, right? You guys were talking about gold. If you look at the Flash PMI report out this morning for September, the election and concerns, it was all over that report. And I think that's going to start to weigh on folks as we get closer. And then finally, just earnings growth.
And Chris, you mentioned a number of potential challenges there. What about seasonal influences as well, Chris? How, as a strategist, do you think about that dynamic?
Well, September is usually a horrible month for the market, right? It stands out with, kind of like a sore thumb. But, we saw that in the first week. Last 2 weeks were pretty good for the market, and we've only got, after today, 5 trading days left. So I'm not so sure that seasonality is going to play out. It could, but I would say the odds of it happening, with 5 trading days to go, mixed at best.
Chris, good to have you on the program. Thank you for joining us.
Thank you.